to the 13th annual conference. I hope I'm audible at the back. I'm trying out a new mic. Okay, so I'm going to dive directly into a topic that might seem a little operational in nature, but I promise you by the end of this session, I'm going to give you a financial benefit, a true financial benefit. And all this while we are hearing people talk about cost, expense. What I'm going to talk about is tax savings. How you're going to save to ensure whenever you give an ESOP, what's your tax savings, okay? If I go into the details of this, it's going to get a little technical. Happy to take questions. But what I would want to highlight here is at the end of this session, you're going to see some true tax savings. And for illustration purpose, I've kept the numbers small, but you're going to have to multiply it to see the magnitude of it. Trust me, the magnitude of the savings that you will see is really huge. And it's not just me talking about it. We have the courts, we have the assessing officers, we have the ITAT saying that this is possible. So it's not just a theory, people are actually doing this. Okay, just to simplify things a little bit, I'll come to some accounting concepts. One is, whenever I make a grant, on the date of the grant, what I do is, I take the FMV on the date of the grant, minus the exercise price, the fair market value on the date of the grant, minus the exercise price. There are some statistical models on top of that, but this is the ultimate goal. The delta goes into your P&L and is an expense, okay? So I have here the Biocon case, which was a landmark case, which ensured that it confirmed that this particular delta is allowed to be considered as a deduction in your tax books. Fair enough. This is a concept which most of us know and we are already doing this. But there is another part to this. The second part being the perquisite value. So the word true up comes multiple times in this landmark case. So let me just explain what this true up actually means. One is, on the date of grant, what is my share price minus the excise price? That delta is the first part. Please focus on the A and B, because I am going to focus on this A and B throughout the illustration too. The second part of things is the day when the employee actually exercises. That day, whatever the fair market value is, minus the exercise price, that's also an allowed deduction as per the tax laws. And as I said, this is a landmark case. Does that mean there have been no other cases? No, there have been multiple cases. I'll get to that. But this has been a landmark case which has clarified quite a few things, and people are going for this. Okay, so we have got quite a few cases that have happened in the past. Unfortunately, in 2009, the revenue won and said this deduction is not allowed. But after that, we are seeing multiple cases allowed by the Delhi High Court, allowed by Madras High Court, allowed by ITAT, all of them where they have clearly mentioned that not only the expense in your P&L is allowable, but also the true up concept is allowable. But the Biocon case was the one who got a few things clarified, such as the revenue had a problem with contingent liability. They were of the opinion when you're giving these ESOPs to employees, it's a notional loss. It's where is the cash going out? So all of that kind of got clarified in the Biocon case. That's why that's a landmark case. Other than that, there are many cases that are happening and have been happening, and people are winning. So other than the first part where you saw Ranbaxy lost, rest of all the cases may be at the High Court level or at ITAT, we are winning. So the companies are winning and people are actually taking these deductions. So the law has consistently evolved in favor of companies, but that's possible if your ESOP data can actually survive a scrutiny, because the assessing officer is just not going to listen to your word. They are going to want to scrutinize your data. They are going to audit your data. I'm also going to explain in the future. We have done certain cases where we got this data audited by the assessing officers, and this has to go to the granularist level. It has to go to the employee level. So I'm going to give some example. This is purely for illustration, kept it simple, kept the numbers small so that they are visible, but this is what you are going to multiply with the number of options you grant. So let's take a simple example. Say there is an employee, we have granted 10,000 stock options. The exercise price is at 100. Keeping things simple, fair value is 10, and they have a vesting of 3 years, and the exercise price is 100, like I mentioned earlier, and the fair value of options is 30. The statistical model I was talking about gives you a fair value of 30. Simple. What's my cost that goes in my books? Is 30 into 10,000, that's 300,000. So till here we are clear. The A part of things where Biocon mentioned that 300,000 is something that I'm allowed to take in my books as an expense. So what happens? I take this in my books. I have considered an average 25% corporate tax rate for simplicity purposes. So if I just grant 10,000 grant options at a fair value of 30, which is way low than what is the fair value I know of most of the people sitting here, your tax savings on only this part of your P&L and your deduction is 75,000 rupees. Amount seems small now, but I'll show you the magnitude of this. So this is your part A. Let me move to the next part, a concept known as deferred tax asset. Please don't get overwhelmed with the terminologies, typical tax terminologies. Let me explain this a little bit. Like I said in the beginning, when I make a grant, I do an option valuation based on the fair market value of the grant on the date of the grant, right? But the tax authorities say that you are allowed to take this deduction at the time of exercise. So there's a time period that goes in the middle, right? As time goes, your FMV is expected to increase. So with a larger delta, you have a larger expense that you can deduct. But is it happening today when I grant? No, it's going to happen in future when employees actually exercise. Now, all said and done, if an employee exercises, say, 3 years down the line, your FMV is expected to increase. In this illustration, I've taken an FMV going to 150, 170, and 180. So you have a delta of 50, 70, and 80. So now what is happening? One is the fair market value on the date of grant, and the other is the fair market value on the date of exercise. So there is a difference, right? And I want to take advantage of that difference, right? But there is also a time difference. I can't book this cost on day 0. I can book it only and only if an employee exercises. The tax department is not interested in knowing if you made a grant or not. They are more interested in knowing if you have passed on the benefit to the employee. You only pass on the benefit to the employee as per the tax department when that employee exercises. So the tax department is not interested in all those grants you made that got cancelled, that got lapsed. They are only interested in all the grants that you made that got exercised and the actual employee benefit got transferred. So now there is a time difference, there is a cost difference. This difference is called deferred tax asset. So you create this difference, you find out what's the difference of that, and you book it in your books as an asset. For those of us who are not from finance background, this is something that does not go into your P&L, this is something that goes into your asset. You're creating an asset to be claimed in future. To keep things simple, again, I have considered a corporate tax of 25%, and this is your B. So you have, the first time you remember the A, that was 75,000 rupees. The B part of things are 125,000 rupees. What was the original cost, you remember? It was 30 into 10,000, that was 300,000. And what is the tax benefit I'm giving you? The tax benefit is 75,000 plus 125,000, that's 200,000. So you are getting a tax saving of 200,000 on a cost you booked of 300,000. That's what? 66.6%. So what are we seeing here? That we are seeing a 66.6% tax savings on the ESOP costs that we are booking, right? Just to simplify this further, I've kind of created a timeline so we know when we get this benefit, because it just doesn't happen on the day we make the grant. So these are some numbers you may have seen in the previous slides. The cost over the years, 1,83,000, 2,67,000, our ultimate number 300,000. If you remember, 300,000 was the cost we booked, we planned to book when we did the grant, right? Okay, and the savings that we had done, the A value of it, that was 75,000, will get amortized as this over the years. So this is the A part of things, right? Now the B part of things, because like I said, there's a time difference. It doesn't happen on day one. It has to happen over a period of time. So the first part of things are pretty simple. They happen as and when the years go from your date of grant till your date of vesting. So we are clear there on the A part of things. On the B part of things, that is the DTA, deferred tax asset. Don't mind the numbers. The ultimate number that we were looking at, 125,000. So in totality, we have 200,000 in tax savings if we are booking a cost of 300,000 in our books. So that's, let me repeat myself again, that's like 67% tax savings on your 300,000 cost booking. Now you can multiply it, just think what's your pool size, what's your grant size, and simply multiply it. That's the magnitude of this tax saving that we are looking at. So is it really worth it? Because what you heard first is courts are agreeing, assessing officers are agreeing, numbers look big, but looks like it's going to take efforts, because the moment we say courts and we say assessing officers, it kind of looks like it's going to be a lot of effort. Tax teams here may be comfortable with it because they're always dealing with these kind of cases, but for the finance team or the HR, it may look like a big effort to get a 66% tax saving. But I think it's still worth it, right? With the 66% tax saving, it's worth it to go back to your assessing officer and get this sorted. And since we have got so many cases that have, influential cases that have happened in the past, we are sure to win, is what we are seeing as per history. So, but while we are doing all of this, there are certain complexities we have to take care of. Obviously, nothing comes for free, right? So what are some of the complexities? Companies will not have one scheme, one grant, one instrument. Companies will have multiple instruments, multiple schemes, multiple grants in that. That adds to the complexity. Then we have, every grant will have a separate valuation. So you remember 30, that's not going to be 30. That's going to be multiple valuations you will have as per your grants. And that's also going to be multiple FMVs based on when your employees are exercising. To top it up, you will have cross-charge, a concept which we are adopting. It's happening, but what we are seeing is, say there are subsidiaries, there are group companies, you're supposed to pass on the charge to your group companies. So this just adds to the complexity even more. And life is always not simple. We have lots of corporate actions, we have modifications, and we have other such things that happen around us that make this a little complicated. But that's where I'm coming from. If your data is in such a situation that it can be scrutinized, it's in a digital form, this is very easy. If it's in an Excel, if it's not maintained properly, if the digital form does not have audit trails, this is very difficult. So Is this just theory? No. We at Capita have been supporting quite a few clients. We are helping them get this data sorted. So what have we done? I just picked up one case which was very interesting because the numbers were pretty high, thousands of crores of tax savings was what we were seeing. That's why I found this case more interesting, because of the numbers. Obviously, I'll not mentioning the name of the client because it's still in IT discussions, but the company is a prominent listed company, listed on NSE, BSE, 15 years of ESOP history. They also, 15 years of history, so all finance people know that they transited into Ind AS with all of this history baggage that they were carrying. And we had a scope where we had to do a calculation of the tax deduction over all these periods, all these assessment years. While we were doing this, what we did was employee-wise, grant-wise, West-wise, we drilled down the data to the granulous level. We were able to do this obviously because the client was on a platform and we could support them. Every exercise that happened had a trail back from the day it was granted between all the corporate actions and transitions that happen in the middle. Ultimately, the outcome was we could give a defendable data to the assessing officer line by line. And that is what I am saying, that this is a practical scenario where we have actually built this for quite a few clients. So the ultimate takeaway, like I mentioned, we have been talking costs since morning. What I have delivered is tax savings. How do we get those tax savings? If your data is clean, you have a deduction in place. If you have a deduction in place, it ultimately results in value. That's your tax savings. So call to action. Go back home, check your ESOP data. If it's in a good form, very good. If not, let's do an internal audit of what that data looks like, and we need clean data to leverage the tax savings we can actually have, right? So after the internal ESOP audit, if you find any gaps, please clean them up. And it's a recommendation to have all of this digitalized, because all of this history cannot be maintained if it's not digitalized. Thank you. Any questions? No problem. We can also take questions during the breaks that Ekta gives us. Thank you.